Thank you for joining me on this video. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Today we are going to be doing a special weekend update for the week ending Friday, February 28th, 2020. We've had a very bad week in the markets, and so I wanted to do this special update for you. So this is going to be a little bit longer video than normal, but there is going to be a ton of great information here for you, so I would encourage you to watch this entire video at least once. So stay with me, and I think you're going to really enjoy this. What we're looking at here first, guys, is the performance of the S&P 500 as well as all 11 underlying sectors. And of course, for these sectors, we're using the sector ETFs. But you can see here the S&P, this is just last week. The S&P 500 is down 11.49% for the week. And we closed at 2954.22. And by the way, we are using my stockcharts.com charting service, of which I am a paid member, and I will leave a link to their site in the description box below this video. Now, what we can see here is that for the week, communication services was the best performing sector. It was only down 9.55%. And as we go down here, we can see that the energy sector was the worst performing sector for the week, down 16.38%. Now, I'm going to loop back around, and we're going to do some really cool analysis on the sectors looking back over the last 5 years, so you guys can really get some perspective on what's been happening underneath the hood, so to speak, of the S&P 500, especially the last couple of years, but the charts will show 5 years of data, so it'll give you some pretty good perspective on what's been working and what hasn't. So stay with me, we'll come back to that, but I wanted you to see here that the best performing sector was still down 9.5% for the week, and we had a few sectors here: technology, consumer discretionary, healthcare, consumer staples, and communication services that all outperformed, right, on a relative basis, all outperformed the S&P 500. The sectors that were down more than the S&P 500 itself were the utility sector, down 11.59%, real estate 12.26 to the negative, industrials were down 12.57, materials down 12.63, and then financials down 13.58. And then, of course, energy was down 16.38. Now, let's move over here to a daily chart. Now, I've kind of really focused this in. This is just a 2-month time span because I want to go back and I want to revisit what has really happened over the last week or so. All right, but let's start up here. Let's start on the 19th. See, I'm going to go up here, and this is why I wanted to make this just a 2-month chart, but each bar, each candlestick is a day of trading in the S&P 500. But right here where you see my cursor moving, that is the all-time closing high for the S&P 500. That was on Wednesday, February 19th. We closed at 3386.15, 3386.15. So that was the only close that we've had above 3380 on the S&P 500. That 3380 level had been, maybe throw some annotations in here for you, that 3380 level had been acting as overhead resistance, and then we had some short-term support coming in around the 3370 level, which would be right in there. And so you can see there for about a week, we'd been closing, above this 3370 level. We had this close above 3380, which again was 3386.15. And then we had a negative divergence, if you will, because we couldn't hold it, right? We closed down beneath the 3380 the next day on Thursday, but clearly above this 3370 level, and then unfortunately we sold off on Friday. So this is a week ago, okay? But I'm giving you the setup for what happened technically in the markets during this last week. And I'd been warning that this had been a very long run above the 50-day moving average, which is the blue line, and also we were pretty extended above the 200-day moving average. At one point here, we were about 11.5% above the 200, which isn't completely unheard of, but when you are that far above the 200 and we had the second longest run above the 50-day moving average without one close below the 50, We'd been above it for 19 weeks, and that was the second longest run above the 50 I could find, going clear back more than a dozen years. The longest run was 24 and a half weeks, and that was back in 2013, which was an absolutely stellar year in the markets. So I knew right then that we were long in the tooth, and I'd been warning my subscribers, and I'm going to share a little bit more information with you about that, but subscribers to my service, Simple Market Signals, I've been warning them for a couple of weeks here that a pullback was quite probable just based on the age and the velocity and duration of the move we had had since the early part of October. But again, we'll loop back on some of that, and I want to show you how I can help you. I want to show you how Simple Market Signals can help you, and we're going to use this, we're going to kind of trickle that in through this analysis. So on Friday the 21st, we broke beneath this 3370 level, which had been acting as a area of support for about a week, as you can see here. And that was one of the first indications that the market was starting to weaken, along with the fact that we couldn't hold a new all-time high. Okay, 3380 had been acting as overhead resistance. We got that new all-time high, and then the very next day it failed, and we closed beneath the 3380, and then the next day we closed beneath 3370. So going into the weekend, right, into the Friday being the 21st, a week ago, going into the weekend, we already kind of had a negative setup for the week, and then of course, over the weekend, more news came out about the spread of the coronavirus. Unfortunately, more people passing away from that, and we gapped down on Monday. And you can see here that we opened below the 3260 level. We closed near the lows of the session on Monday, and for most of the week we did that. But you can see here is Monday, Tuesday, Wednesday, Thursday, and Friday's trading. All right, so every single day last week was negative in the markets. Now, one thing that was positive, though, and what we're looking at now is just Friday. So this is a one-day chart where each candlestick represents 1 minute of trading in the S&P 500, okay? So on Friday, we can see here that we gapped down. So this is Thursday's close, and we closed right at the low on Thursday. So that was not a positive setup. So when we gapped down and we opened here lower, okay, so that's this here. So we opened lower on Friday, and then we traded down and bottomed just shortly after 10 a.m. Eastern Standard Time on the S&P 500, then started moving up from there, right? And then we pulled back and kind of went sideways for a good portion of the day. Now, what's important is starting at 3:45 Eastern Standard Time, we started a rally, and we rallied into the close, and we rallied into the close on higher volume. That is the most positive thing I saw all last week in the trading. But unless you're looking at short-term charts like this, you can't see that, okay? You can kind of see it in the candlestick in that there's a long tail on this candle, and we closed towards the high of the session. So that gives you some clues. But when you really, this is what I call putting the market under the microscope. When you really zoom in and put the market under the microscope and look at these 1 minute charts during the course of the day, you can really tell what happened. So the fact that we're going into a weekend, the fact that we rallied for the last 15 minutes, and the fact that we did it on increasing up volume, to me is all positive. Now, I am not suggesting we bottomed here, but we have perhaps hit some key levels, which I'll show you as we go through here, support levels. And so from a technical standpoint, it should be harder for the market to fall from here. However, you never know for sure, okay? And so again, we know we had a tough week. Everything was down, and most everything was down at least 10%. And by the way, a 10% plus correction from the all-time high in anything, whether it's a stock or a sector or the overall market, that constitutes a correction. So we are now in correction territory in virtually everything, the S&P 500 as well as all of the sectors. Again, we closed down. So if we go back to the all-time closing high on Wednesday, the 19th, where we closed at 3386.15, okay, right here, 3386.15, to where we're at right here, we are down 12.76% on the S&P 500 from our all-time high. Also keep in mind that a bear market, which is where you're down at least 20%, that would take us down to, I did these calculations this morning, that would take us down to 2708.92. So we would have to fall to the 2708.92 level. So let's go over to a 1-week chart on the S&P 500 to kind of give us. So this is a 5-year chart, but each candlestick now represents 1 week in the S&P 500. And let's do some annotations here so that we can kind of see where some of this would come in. So if we needed to get down to, let's just call it 2700 for easy math. All right. So this is where we would have to be down around this area and lower to get into bear market territory. All right. Right now, all we've done is we've corrected. All right. So we're down over 10%, but less than 20. So a 10% correction, a 10% pullback is a correction. A 20% pullback from your previous all-time high constitutes a bear market. So we would have to get below this 2700 level to 2708.92 to be exact, but let's just call it 2700 for conversational purposes here. But we would have to get below this level right here in order to get into a bear market. Okay, is it possible? Yes. Is it probable right now? I don't think so, unless the coronavirus continues to spread and we can't get a handle on this thing. But let's focus on where we're at right now, because I want to show you some key support areas and talk about some of this. So we're setting right here. Again, we're at 29.54.22 is where we closed. So 29.50 is going to get us really close on this line. All right, and you can see that we tested this area back in October. As a matter of fact, we had some days. Now this is the weekly, right? Again, every candlestick, it represents a week. So this is last week's trading here. But when we look here, as a matter of fact, that's all right. I was going to make it to a 3-year. Yeah, let's do that. It'll make it easier for you. So I'm going to save these changes, and to make it easier to see, especially if we're working, some of you might be looking at this on a smaller screen. So I'm just going to make this like a 2-year chart so it's easier to see for right now. And then we'll go back to the 5-year view here in a minute. Okay, so we can see here we tested this area back in October. So that's one of the first things I want to point out, just to put things in perspective. So this was a phenomenal rally that we had here for this period since the beginning of October. Where we're at now, guys, basically all we've done is round trip this thing. In other words, we had the rally and we round tripped it. We came back and we've done a round trip from where we started. All right. So I know it's painful, but let's keep this in perspective. As scary as the coronavirus is and everything that's happened, the only thing we've done so far is, from a technical standpoint, is we've given back our gains from October. All right. And as you can see here, we'd been trading around this 29.50 up or down level. We were back around here in September. We were underneath it in August. We were over it in July. We were underneath this area in June. So, we're still okay, and we can still move higher from here. Hopefully the coronavirus won't get substantially worse, and there won't be, a lot more fatalities. And of course, that's going to, it's going to scare people. And what's driving the markets right now is a lot of fear. There's fear of the unknown. People hate uncertainty, and the markets are made up of people. Therefore, the markets hate uncertainty. And so to the degree that there's uncertainty in the markets and there's lack of clarity on earnings and how people are going to act, and keep in mind that 70% of the economy is consumer spending. And so to the degree that people pull back and don't travel, don't go out to eat, don't buy things, don't buy cars, whatever, that's going to have an impact, potentially have an impact on the earnings of companies around the world. And that's why the market has reacted so quickly. Now, we were already fairly extended, as I had been warning my subscribers for the last couple of weeks in my newsletter, and I'll show you a few things on that here in a couple of seconds, because I want you to understand how you can benefit from working with me, okay? And by the way, guys, relax about the cost of this. I'm just going to give it, here's a spoiler alert. It's less than $20 a month, okay? And you're going to get information. You're going to get proprietary information from my model that I created for my own personal trading and investing. And it's a risk-based model that helps determine market risk. I created it for myself. Even as good as I am on technical analysis, I've got over 20 years of financial services experience. I'm a former financial advisor. I'm a former VP and regional sales manager for Oppenheimer Funds, the mutual fund company. I've got over 25 years of experience trading stocks and options, investing in ETFs, investing in mutual funds. But guys, even with all that experience, Okay, all my securities licenses that I had, all my designations, everything I've done in this industry, the technical analysis leaves a void, and that's what I want to get through to you here. This gives us price action. The problem is it really doesn't show us where the risk is in the market. What is the risk level? Okay, and that's where I for 20 years I worked on this problem, and finally in 2017 it all came together. The missing piece, the missing component of my model I was finally able to figure that out in 2017. And then once I started working with this thing, simple market signals, I call it, once I started working with my model, I'm like, man, there's a lot of people that can really benefit from this. And that's when I built a business around it. Okay. So stay with me. I'll tell you more about it. But hopefully this is helpful in that you understand that the only thing we've done so far is done a round trip, right? We went up and we went down. And by the way, the market, as you can see here, takes the stairs up and the elevator down. So stairs up, elevator down, which is also why, whether you're going to use my system or something else, have a risk mitigation model, have a loss cutting strategy in place, guys, because those are the people with a loss cutting strategy. Those are the people that make money in the markets over time. They make the most money. Okay. A buy and holder investor can make money. But I believe that buy and hold investing is harder than ever, and I believe with these ultra low, we hit a all-time low on the 10-year Treasury yield on Friday. Okay, this last Friday. All right. So with bond yields going down, traditional portfolio 60, 40, 70, 30, it's just not going to work as well as it used to, guys. Okay. So whether you choose to work with me, and be a subscriber to Simple Market Signals, which I hope you do because it's proprietary and it works, or you're going to do it on your own, you better have a loss-cutting strategy in place, guys, because this type of stuff, you had a really nice profit here, and if you could have captured some of that up in this area, you'd still have most of your profit. But, anybody that's a buy and hold person has it's all evaporated. But also, again, let's keep it in perspective. All we've done is we've round tripped this thing. So far, the damage to the overall market hasn't been tremendous. Now, if we fall this other, 250 or so points to the 2,700 level where we go into a bear market, obviously that's going to be pretty traumatic. And you can see going back here for the last couple of years, now we're back into 2018 here. There's been quite a bit of trading for the last few years in this area. So technically that should provide support for us, but also it's going to do a lot of damage to, even more damage to portfolios, individual portfolios, pension funds, everything, if we start to trade much below this 2950 level. And by the way, the blue line here, that's the 40-week 200-day moving average. The green line, that's the 10-week or 50-day moving average. So you can see we're well below the 200-day, the 40-week. We're down here into these areas that we were where we were at in October. And again, this 2,700 level would put us into a bear market. Okay, so let's go back out of this chart and let's get us back to a 5-year. So we can get a little bit more perspective on where we've come. So, as you can see over the last 5 years, though, the S&P 500 has had a very nice move, and we've made some serious progress. So, again, the fact that we've just given back some profits that we made over the last 5 months, it's not fun. It would have been better to capture those profits, but if you didn't have a chance to, just understand that this level, as you can see here, this 2950 area, it was acting as overhead resistance here, then some support here, overhead resistance here, support there. You had overhead resistance there, overhead resistance to some degree there. So, and this is going clear back into 2018 now. This area here should start to really provide more support, technical support, than what we saw here, okay? Because there's a lot more trading over a lot longer period of time between this 2,700 level, where we would have to get to be into a bear market, and the 2950-ish, again, 2950, 422 to be exact, but the 2950-ish level that we are trading at now, okay? So a lot more trading over a lot longer period of time. That should provide a lot more technical support than what we have seen this last week. Okay, so what we're going to do now, let's start rolling through the sectors so we can start taking a look at the underneath the hood of the S&P 500, so to speak. And what we're looking at here is the materials sector. The ticker for the ETF for that is XLB. And what we can see here is we are trading, basically, guys, this is going clear back into 2017. So the materials sector is lower than what we saw in 18, 19, and we're clear back to basically almost 3 years ago. All right, so somebody that's a buy and hold investor just in that sector, the material sector, hasn't made any money since 2017. All right, so that's a very it's negative, right? We're not making any progress here. All right, so let's kind of roll through these now. Communication services, companies like Facebook are in here. So where Facebook used to be in the tech sector, the communication services is kind of a newer sector. Came out just a couple of years ago, a carve out, and you can see here that this has had a just tremendous run, right? This is some of the back data, but you can see where the volume kicks in. That's where that sector actually was created, and this ETF was created to track it. But you can see that this has been a pretty strong sector on a relative basis, especially compared to the material sector. It's doing pretty well. It is beneath its 200-day moving average, but not substantially. And you can see here that it's kind of pulled back to, again, some support levels there, and support and resistance levels. So hopefully that this communication services area will hold up on a relative basis. It should be a pretty good sector going forward for those that are doing sector trading. Now the energy sector. Let's spend a couple of minutes perhaps on this one for a couple of reasons. Number one, guys, look at how negative this is. Okay. And it's trading near, now this is going clear back into 2016, if you can see where my cursor is moving on the left side of the screen. But, and this is trading right at the end of this candle, but you can see that these closes here, so where the candle body is, that's actually where we closed during those given weeks. We closed this week in the energy sector, the XLE, we closed beneath. I mean, it's at the lowest its point has been in 5 years, guys. This is why you do not, I don't care whether it's the markets, an individual stock, a sector, whatever. Don't try to catch a falling knife. This is an ugly chart, okay? Don't just be, and I heard people, really well-respected. There was a billionaire on CNBC this last week, or maybe a week ago, talking about, well, energy stocks are really cheap down in this area. Okay, he was talking about how cheap they were. Well, yeah, they got a whole lot cheaper this last week. All right, down another 8.87%. So trying to bottom fish and chasing things that are cheap relative to where they've been trading, guys, it doesn't work. All right, I would really encourage. You got to do what you got to do, but I'm just telling you, I'm not going to do it. And this is indicative of a weak sector and weak stocks in the weak sector, and you do not want to get sucked into this stuff. So please don't trade that way. You got to do what you got to do, but I would encourage you not to do that. That is a very, very weak sector. All right, so let's move on to financials here, the XLF, and you can see here that financials, if we go across here, are pretty much trading where they were at the end of 2017 and for most of 2018. Of course, 18 was a negative year in the stock market. And then we got back above this area here in 19. So again, for about 2.5 years, no people have not made any money in the XLF in the financial services sector. Okay, if they were and this is inside these things are all components, by the way, guys, of the S&P 500. So now we're lifting up the hood of the S&P 500, and what we're looking at here are the 11 sectors that make up the S&P 500, because I want you to understand what's going on beneath the surface. All right, so now we're looking at the industrials, the XLI, and again, you can see here, if we go across to where we're trading around the 73 mark, you go across here, pretty much exactly where we were at the beginning of 2018. All right, so again, really no money has been made in the industrial sector as of the close of this week, right? We had a little profit up to this point, but using this weekly close from Friday, from yesterday, we can see that, for a little over 2 years, no money has been made in the industrial sector. All right, now let's get to technology, which has for quite a while been the strongest performing sector in the S&P 500, and you can see on a relative basis, this is a gorgeous chart. Whether you're looking at individual stocks or sectors or the markets, this is what you want to see, guys. This is an absolutely gorgeous chart, okay? Now, and look at this. And by the way, it's the only sector, and you'll see here, it's the only sector that's still trading above its 200-day moving average. So on a relative basis, this thing, even though it was down 11.13% yesterday, on a relative basis, you can already see that, it's trading near, it's pulled back, no doubt, but, you can see here that really we're still ahead of where we were in November of 2019. So on a relative basis, so far in the XLK, in the tech sector is holding up pretty darn well. And part of it is it's just been such a strong sector over, the last 5 years plus. And again, the 40-week to 200-day moving average, we've come down and kissed it, a few times here. But it's spent, since early 2016, it's spent a large percentage of its time till we got to the tail end of 18, early 19. The XLK, the tech sector, spent a large percentage of its time above or the 200-day, the 200-day, the 40-week moving average. So, but again, on a relative basis, that is a really nice looking chart. Now, the XLP, the consumer staples sector, if you guys haven't seen my video from about a week ago that goes into the interest rate sensitive sectors versus rates, I would highly encourage you to watch that. It is super educational. And I spent some time on the consumer staples, utilities, and real estate sector versus interest rates. You guys have to go out and watch that. It is super educational. But the consumer staples sector, as you can see here, has up until recently been pretty strong. And really on a relative basis, it's still doing quite well. It's still above where it was in the first part of 2019. So compared to some of these other sectors, you can see the XLP has done pretty well. But personally, I don't want to see the market being driven by utilities and consumer staples. These are some of the most conservative sectors out there, and that's where a lot of the strength over the last couple of years has come from. You'll get more information, real detailed information in that other video I was telling you about. But and I'll leave a link to that in the description box below this video as well, but you can find it on my YouTube channel. And by the way, guys, go poke around on my YouTube channel. If you haven't already subscribed, please do so. I give everything I have, guys. All my 20 plus years of financial service experience. I give away so much good information on this stuff, if I do say so myself. And you guys are going to really benefit from being subscribers, watching my videos, rewatching my videos, poking around on my channel, find something new to watch, going back over it, because it's taken me my entire adult life. Okay, 40 years, over 40 years now. Okay, I'm in my late 50s, unfortunately, but for me. But I've been at this since I was 17, 18 years old, studying success, studying things, and and so I bring all this to bear in these videos. I give you the best that I have to offer. Okay. My best stuff has to be reserved for my subscribers, but I give you guys a ton of fantastic information here. So anyway, please subscribe, poke around on the channel, check out my other videos. You're going to benefit from them. But you can see here on a relative basis, the consumer staples sector, it's holding up pretty well, right? We've only given back our profits from really, the middle of 19, and we're still above where we were any time prior to that. So on a relative basis, still doing okay. And by the way, as I'm going through these guys, I am not making recommendations for you to buy any of these sectors. I'm educating you, okay? If you want to trade and invest in individual sectors, that's great. That's not what I do, all right? So I'm just trying to educate you so you understand under the hood of the S&P 500 what is happening, okay? What's really driving these markets. Now, again, a very interest rate sensitive sector. Falling rates has really benefited this sector as well, but real estate has been very, very strong. But you can see here, had a bad week, down 12.26% for the week. And again, we've reversed pretty much the gains from middle to maybe the last two-thirds of 2019. But we're still ahead, price-wise, we're still ahead of where we were in 2019 or any time prior to that. So on a relative basis, real estate's still holding up fairly well. And then getting into the utility sector. And again, you can see here, it's had a pretty good-looking chart, but personally, I don't want to see this because this is not the sector I want driving, the stock market. Okay, but down 11.59% on on the XLU, the utilities ETF last week, trading just below its 40-week 200-day moving average. And again, it's price-wise, it's still ahead of where it was for the first part of 2019. So again, the XLU on a relative basis, the utility sector on a relative basis, holding up pretty well. But yeah, again, I'd rather see that. I like to see the tech sector being the leader. I mean, that's where we want the growth. Okay, and then now we're going to be looking at the healthcare sector, the XLV, and you can see it's doing okay on a relative basis. But again, we're back down here to where we were trading in the latter part of 2018. In this area too, and I'm not trying to make a political statement, guys, but it is what it is. This area, the healthcare stocks, can be heavily influenced by politics as well. Depending on who's saying what on what side of the fence, what side of the aisle. The healthcare sector can be buffeted quite a bit. Not Warren Buffett. That's not what I'm talking about. I'm talking about the buffeting like headwinds can be buffeted around quite a bit because of politics. So this is probably the sector that's the most affected by political rhetoric. So keep that in mind if you're going to be investing directly in the healthcare sector. But again, you can see that we've given back virtually all the profits from 2019 and the latter part of 2018. But on a relative basis, still holding up fairly well. Now let's move on to the last sector here in this part of the analysis, and this is the XLY. This is the consumer discretionary sector, and this, along with technology, guys, in my opinion, is this is the second most important sector in the S&P 500, in my opinion. And the reason for that, again, and I alluded to that earlier in the video, is that the economy is 70% consumer spending. This sector, the consumer discretionary sector, is under a lot of pressure because there's a lot of retailers in here, okay? But Amazon does make up over 20%. Because keep in mind, the whole S&P 500 is cap weighted, right? So it's capitalization weighted. Larger companies make up a larger share of the S&P 500. Smaller companies make up a very, very small percentage of the S&P 500. But Amazon is the largest company in the XLY, the consumer discretionary sector. It makes up over 20% of that entire sector. So as kind of, the way to think about this is as goes Amazon stock, so goes this sector. Amazon's stock does well, this sector probably is going to do pretty well, okay? So just keep that in mind. But this is a pretty important sector. We want to see this do well because, again, it's reflective of where consumers are spending money, or at least that they are spending money, all right? If this sector starts to underperform, then we know that the consumer is pulling back, the economy is going to start getting weak, and again, that's going to be reflected in the stock market. But also, with that point said, guys, remember, the stock market leads the economy, not the other way around, okay? Stocks will move ahead of economic events, both up and down. So remember, this is why I do my work in the stock market. I pay very little attention to economics. I'll look at fundamentals. I consider myself a techno-fundamentalist, but I spend no time, virtually none of my time, studying the economy, okay? Because economic data is lagging data. I can't work with lagging data. You and I don't trade and invest in the economy. We trade and invest in the stock market. Therefore, everything I do in my entire business, Simple Market Signals, it's all based on the market, not the economy, okay? But again, with the consumer discretionary sector, again, we've pretty much wiped out all of our gains from, say, middle of 18 and beyond. But again, you can see on a relative basis, it's holding up better than a lot of these other sectors. Now I want to show you how you can benefit from Simple Market Signals. Now, keep in mind, these signals are green, yellow, red. Just like a stoplight, green means go, yellow means caution, red means stop. The way that applies to the markets, green, you're probably going to be making money, right? From a risk-reward standpoint, it has the least amount of risk per unit of possible return. That's a green signal. Yellow, the market is generally sideways to slightly down. That's the caution signal, right? Transition period. Red is a dangerous time frame, all right? So let's go back to the end of 2000. And this is back testing, by the way, okay? Because as you heard earlier in the video, the signals, everything finally came together in 2017. But once I had the model, then I went back and looked at some previous downturns to see how the model would have helped me in that time period. And here's what I found. The signal would have went red back here in the latter part of 2000, right around the 1450 area, and I'll show you the exact numbers on this in a second. And then you would have missed most of this downturn because I don't stay invested when it's red. As a matter of fact, I don't really stay invested when it's yellow. I invest in the green periods because I've learned that's when I'm going to make money and take the least amount of risk per unit of return. But you would have been able to get back here, okay, on the green signal, so if you wanted. So out here, in there. Now, let's take a look at the math behind this to see how that would have worked. So again, the signal went red at around 1450 in September of 2000. It would have went green. I'm just going to go through this very quickly. Would have went green around 890 in April of 03. That's 560 points in the red zone. That is a 38.62% loss that you could have avoided, potentially avoided, if you just would have minimized or eliminated your exposure to the equity markets during that downturn. Now, the math behind this, guys, is so important to understand that if you lose 38.62%, it takes 62.92% to get back to break even. You know how hard that is? All right, so let's fast forward here. I'm just going to go through this really quickly, okay? Here's 07, okay, 07 through 09. So 07, you could have gotten out somewhere around in here, could have got back in somewhere around here, okay? And so let's take a look at and that's 2007. You could have saved yourself another 40% loss. So you could have got out somewhere around 1,500 in November of 07 when the signal went red. The signal went green around 875 in April of 09. 625 points on the S&P 500 in the red zone. That is a 41.67% loss. You lose 41.67%. It takes 71.43% to get back to even. So guys, whether you choose to work with me or not, just understand, okay, if you're going to take nothing else away from this part, which I hope you join me, I mean, for less than $20 a month, I mean, most of you would probably spend more on pizza or Starbucks in a week than what this costs for a month, all right? But this is what you're going to, this is just part of what you're going to get is the signals, all right? I chock those newsletters full of information. It's sent out every week on a Saturday. I send special midweek updates if you need them. But anyway, if you lose 42%, right, 41.67, it takes 71.43% to get back to break even. Now, let's also take a look at another, real quickly, let's look at calendar year 2018. The model came together in 2017, so this is real signals now. Those other ones were back testing, but very accurate in the representation. But here's what would have happened in 2018, which, by the way, the markets were negative in 2018, okay? Even reinvesting dividends, the S&P was down 4.75% in 2018. You can fact check that by Googling it. And without the dividends, we were down, I don't know, 6.7 or something like that. But you can see here, going into 2018, the signal was green. When it turned yellow, and I just batched the yellows and reds together, you know, so we can see it really easily. But you can see here that during the yellow and red period, we went sideways to slightly down. We had a short green period. Sometimes that happens. Doesn't happen very often, but sometimes it happens, where you might have gotten in and out around the same price. And then a short yellow, which, again, if you get out on the yellows like I do, you would have sold out here, bought in here. You would have bought back in at a slightly higher price. Guys, that's the price you pay for protecting your capital, to make sure you don't take big losses. Take small losses. You can recover from a small loss. And by the way, I've got videos out on my YouTube channel that talk about, you know, the importance of losses. So go watch that if you haven't seen it already. It's fantastic. But here's a green signal, okay? So if you would have been, in 2018, if you would have just been invested here and here predominantly, right? And even here, of course, that's a green signal. But you could have been invested about 4 months, 4.5 months of the year. You would have made money, where somebody that was a buy and hold investor lost money, because here's the yellow and red period, and we ended up, you know, down, even including dividends, almost 5% in 2018. Now, here's the transition. So this here, right, this signal here is this one here, all right? And then the signal went red. So this is the transition. This is September of 18 through March of 19. You can see it on the bottom of the screen there where my cursor was moving. Again, I'm talking quick, just going through this. I just want you guys to get exposed to this, and then I'll show you how to get more information if you need more information, or I'll show you how to subscribe. But the signal went yellow here, went red here, right? And then the market snapped back just, bottom December 24th, and then snapped back really quickly, and you can see the signal went green here. Now, another thing I want to point out, this isn't a magic bullet. It's not going to pick the exact bottom of the market. As a matter of fact, it does better at getting you out towards the tops than it does getting you in at the bottoms. But if you want to capture your profits and take the least amount of risk per unit of return possible, this is what this does. I designed it for me. I'm sharing it with you for less than $20 a month. Okay, so you can see here, there's the transition period, and then this is what 2019 would have looked like. So again, you saw this. So this here, okay, is the same thing as this. That's in that red period. So here's where we got back in on the green, and then it went yellow for a short period of time, green, yellow, green, yellow. Again, another one of those situations where you might have sold out and bought back in at a slightly higher price. Again, we're in 2019. Now we're in November. And by the way, October 14th is, since we were looking at those previous charts, October 14th is when the signal went green. And then this last run that ended just a week ago when we really got hammered, we had a couple of little yellow signals. 2020 is not on here yet, but there was a couple of short yellows in 2020, but they were very short, just a few days at a time. But the point is here, I want you to understand that this rally, and I'll go back to the other chart and show you this so you can kind of get more, a better image in your head of what I'm talking about. But here's where the signal went green, and then we had a short yellow, just lasted a few days here, and then we ended we ended the year 2019 with a green signal. So this gives you an idea of how simple market signals can benefit you. And I think you can clearly see that when the signal is green, this is your highest reward per unit of risk signal. And that's why I designed it this way. I designed it this way for myself. This is how I use it. I hate losing money, and I don't want to take any more risks than I have to, okay? Now I'm a risk taker in my life. I ride motorcycles. I've got a Corvette. I've done, I've raced. So it's not that I'm afraid of things, guys, but I also understand how to manage risk, which is why I'm still alive in my late 50s, right, after riding motorcycles since I was a kid. So it's learning how to do dangerous things like invest in the stock market in as safe a way as possible. That is how you manage risk. That's how you can take risks without taking unnecessary risks, okay? You need to be able to mitigate your risk, minimize your risk. Being good at what you do is step one, but also having something like this, when you're investing in something as dangerous as the stock market it is these days, you need to understand what the risk level is in the market. And unfortunately, traditional technical analysis doesn't get you there, okay? The reason simple market signals works and where it picks up where technical analysis leaves off, in that I'm looking at breadth indicators, I'm looking at intermarket analysis, so I'm looking at parts of the bond market to tell me what's going on in the equity markets and how they are influencing each other. When the breadth indicators that I look at are setting at a certain level, you need to understand what that means, okay? And again, it took me over 20 years to figure this out. Guys, please do not underestimate what this can do for you, okay? I want to help you. I want you to win. And the best way I can help you is by you subscribing to Simple Market Signals. And again, it's $19.95 a month. You get a weekly newsletter with the signals. If there's a signal change in the middle of the week, a major signal change, I will send out a midweek update so you have that as soon as possible. I break down every weekend. I break down all the sectors. We were just looking at sectors. I break down the sectors on the S&P 500, and I give you a green, yellow, red signal on those as well. So it's not just on the overall market, but the underlying sectors as well. There's a lot of market commentary, which we'll look at next also, so you have an understanding of what's going on there. So now we're going to look at how simple market signals would have helped you this past week, all right, during this massive sell-off. So starting with Monday the 24th, and you're going to see here, and this is this shows you exactly what happened. On Monday, 2/24, subscribers received a special midweek update letting them know that the weekly signal had went yellow, all right? So going right here, the signal went yellow, all right? And even prior to that, and I'll show you this on some verbiage from my last couple of weeks' emails, my newsletters, is I've been warning people that some of the indicators within my model were starting to peak, starting to hit their all-time highs or highs that they normally hit before the market rolls over, okay? So that's another way you can benefit from this, in that I can see, because I know how to, because it's the model, and I understand, hey, these things, when they're peaking like that, It's the next move is probably to the downside. Okay. And so I was warning people back in here to be cautious, but here's where that signal turned yellow. Now let's go back here and let's see what happened next. So on 225, now here's another component of this. I have what's called the early bird indicator, which is a trend indicator. Okay, it's a momentum indicator, trend indicator. So not only do we have a risk component to this system, if you will, simple market signals, so that's risk based, but then you have a trend indicator, okay, which is either positive or negative, and it went negative here. So you had market risk heightened here. That's the signal from the 25th or 24th on the 25th right here. Then I sent out that the email to all my subscribers letting them know that the trend was now negative according to the early bird indicator. Okay. And then what you can see is on the 27th, on Thursday the 27th, that's when the signal went red. All right. So hopefully you're getting the understanding. So here you had the yellow, you had the negative early bird here, and then you had the red signal here, and then we're even lower here. So during this past week, this past week alone, let alone the warnings, which I'll show you here in a second, which I gave to my subscribers, you had multiple opportunities to mitigate the risk, to minimize the damage to your portfolios because of my risk-based system. All right, it helps you to minimize risk and maximize returns. Okay, that's the way I designed it, and that's the way it works. If you use it, again, you get the signals. You have to do it yourself. Okay, I don't run money or anything. This is information that I'm sharing with you, but it works. Over time, you're going to be able to minimize your exposure to the markets when the risk-reward ratio is out of your favor. Conversely, when the signal is green, you're going to be able to stay invested even if news headlines and political risk is out there. You can ignore that stuff as long as the signal is green, because again, simple market signals is market-based. Okay, we don't care about forecasts, opinions, including my own, news headlines, politics, economic data. None of that factors into the model. Okay, it's a market-based model, which is why it works so well, because it's market-based. Now what we're looking at here is verbiage from my newsletter, which went out on February 15th, okay? And so we can see here, here's what I said. Even though the simple market signal's weekly signal is green, there are a few things we need to be aware of. First, one of the key indicators, now this is 2 weeks ago, guys, before the sell-off, 2 weeks before the sell-off. First, one of the key indicators within our proprietary model remains near its high point, the point at which the market generally peaks before correcting at least a few percentage points. I also pointed out that we were trading at over 11% above the 200-day moving average, okay? It's not completely unusual, but it does point to the fact that, this market has moved up very quickly and may be in need of a rest. And then I also talk about the fact that the S&P 500 had been trading over its 50-day moving average at that point for 18 weeks. We made it another week before we cratered. And so these are the types of things, guys, that are in my newsletter. It's not just about the signals. I get into fundamental stuff as well. Okay, giving you earnings estimates and last year earnings data, so we can talk about PE ratios. This stuff really, really helps, and that's why. That's just. And I'm going to show you one other piece of data here from the newsletter that went out on the 22nd. So that would have been this weekend here. All right, so I just showed you the one that went out right here. All right, so I was warning people that I didn't know what the magnitude of the downturn was going to be, but I knew we were getting closer to a correction than not, some type of a pullback. Okay, and of course, the coronavirus, along with the fact that we already had a pretty long run of the market, it was kind of a perfect storm in that you get something on the magnitude of the coronavirus that's horrendous and very scary. But on top of the fact that we had an extended market anyway, that's why we had such a pullback in the markets. And by the way, in case I didn't say it earlier, apparently we set a record for the fastest correction from an all-time high. Okay, again, a correction is when you fall at least 10% from an all-time high. We set the fastest correction from an all-time high ever this past week. So this was a very, very serious, violent sell-off that we all have just been through. Now, I'm going to show you one more piece of data here from my previous newsletter, and then we'll wrap up. All right, now this is from the newsletter that went out on the 22nd, okay? And in the commentary here, I talk about the fact that the signal was still green, the early bird indicator was positive. Again, the early bird indicator is my trend signal, okay? It's either positive or negative. But I go into the current risk level in the overall market is low. This was on the 22nd, according to the model. However, there are early signs. Again, this is on the 22nd, guys, before this massive sell-off. However, there are early signs of weakness starting to appear in the most sensitive indicators within our model. Again, I'm repeating some of this from the 15th, but additionally, from a pure technical analysis viewpoint, there are early warning signs of weakness starting to appear in the markets. Again, I saw that negative reversal that we had because we couldn't hold the new highs that we made on Wednesday the 19th. We sold off on the 20th and 21st, and this is what I was talking about. And then I go on to say it may be a good idea to take profits made during this latest green signal. Again, the green signal had originally started back on October 14th. I go into asset allocators or financial advisors because I have more financial advisors that are subscribers to Simple Market Signals than non-financial advisors. All right, this is really good stuff, guys. So asset allocators or financial advisors may want to rebalance portfolios at this time. Momentum traders may want to reduce their equity positions soon and even be prepared to go to cash. Choice is always up to you, of course, if the current early warning signs lead to a signal downgrade, either yellow or red, from the current green signal, which we had going into the weekend. Of course, it immediately on Monday, it went yellow, and then by Thursday we were red. Okay, so these are the kind of things that you're going to get from me. Okay, and it's less than $5 a week, guys. So I guess you have to ask yourself, do you think you're going to have more success investing with or without this information? More success trading with or without this information, these signals. And guys, there's over 7.6 billion people on the planet, and I'm the only person on the planet with this model, okay? I created this for myself, and then once I realized what I had, I'm like, man, I got to share this with other people, and I built a business around it, okay? But I've made it super cost-effective. It's $19.95 a month. There's no contracts. You can cancel at any time. The first 2 weeks are free. And so I will tee up a video as to how to subscribe to Simple Market Signals at the end of this video. But thank you so much for being on this video. I hope this was helpful. Hope you got a lot from it, and I look forward to seeing you in the next video. Sign up is quick and easy. You just go to simplemarketsignals.com, and I'll show you how easy it is to sign up. First thing I want you to do is you have to accept the cookies. Okay, it's standard these days, so you have to accept the cookies. Okay, so once you reach the home page and you've accepted the cookies, please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. Again, that's just due to international compliance regulations. So click here to get started. And this will take you to the product page. Takes, depending on the speed of your connection, takes just a few seconds to load up. And again, this just reiterates the product there and what you're going to get. Then you click on the Sign Up Now button, and that will take you to the checkout page. And once you're on the checkout page, fill in your first and last name. The company name is optional. And then your street address, the billing address, of course, for your credit card. So if it's a P.O. box, put that in there. And then use your, of course, town, state, zip, your phone, your email. Make sure the email's in there because, of course, it is an emailed newsletter. So we have to have that. And then make sure this box is still checked because that's how your email gets into the system. If that's unchecked, your email will not get into the system, okay? And then double check, make sure you've got one subscription. Make sure you haven't clicked that a couple times because if it says 2, you're going to get 2 subscriptions. So make sure that box or that number says 1. Make sure your recurring total is $19.95 per month. And again, your first 2 weeks are going to be free. So you can see that whatever the date is that you're subscribing, your first renewal is going to be 2 weeks after that date, okay? And then you're going to put in your credit card number, expiration date, and the 3-digit code. Go down here and make sure you read the privacy policy and then the terms and conditions. You would have to read and check that box and then hit the Sign Up Now button. And it is that simple to subscribe. So the whole process should probably take you 5 minutes or so. It's that easy.